The US dollar benefited the most after global central banks announced their decisions. The resilient Fed, unexpected rate cuts in Switzerland, rate cuts in Mexico and Brazil, and an unusually dovish stance from the Bank of England drove the US dollar index to a monthly high. The index is trading at 104.20, adding more than 2% above its March lows. The fresh US economic data reflected rapid business growth and a tightened labor market. Traders will turn their attention to next Friday's release of the Fed's favorite inflation indicator, the PCE. Before that, the market will need to gauge consumer sentiment. In our video review, we will take a look at the macroeconomic releases that traders should not miss. You are watching the Traders Calendar. The week will start off relatively quiet for the markets. At the same time, despite the modest list of releases, a lot of speeches from central banks' governors are expected, which should be taken into account when formulating trading strategies. On a Monday, markets await the release of fresh data on new home sales in the United States. The housing market has been hit by the Fed's aggressive monetary policy. Sales of new homes in the United States rose by 1.5% in January to 661,000, below market expectations of 680,000. Nevertheless, the figures marked the second consecutive month of higher sales. If broader activity remains strong, further normalization in home sales and new supply could be a sign that home buyers are adjusting to higher interest rates. If the data meets expectations and the growth outlook is confirmed, it would help the US dollar index build bullish momentum. If the data falls short of expectations, the index may come under short-term pressure. On a Tuesday, the market will get a snapshot of a consumer sentiment. Germany will kick off the series of releases. There is a lot of uncertainty among consumers. In addition to rising prices, another important reason for this is the weaker economic outlook for the German economy. The consumer sentiment index rose slightly to minus 29 points in March, from a revised minus 29.6 in the previous months. Income expectations reached the highest level in 2 years, and the propensity to save reached its highest level since June 2008. Analysts expect sentiment to improve with a new report, with the index rising to minus 27.8. If the data is in line with the forecast, the euro could find short-term support. At the same time, if the data shows a sharp deterioration, it will put pressure on the European currency. In the US trading session, investors will gauge US consumer sentiment. Orders for durable goods, from toasters to airplanes designed to last 3 years or more, dropped by 6.1% last month. It was the biggest decline since April 2020. Analysts expect sentiment to improve and orders to rise up to 1% from Tuesday's data. If the forecast is correct, the US dollar will have a good basis for further gains against major currencies. At the same time, another report, the Consumer Confidence Index, will be released later in the day. US consumer confidence declined in February after 3 consecutive months of gains. The Conference Board reported that the Consumer Confidence Index slid to 106.7 from 110.9 in January. Responses for February showed that while overall inflation remains the top concern for consumers, they are less worried about food and gasoline prices, which have declined in recent months. The new data is expected to show that the consumer sentiment is unchanged, although the numbers could surprise again given the latest US inflation data. A rise in consumer sentiment could be positive for the US dollar, while a weaker than expected reading could reduce optimism for the US currency. On Wednesday, the market's focus will shift back to inflation, and the Australian CPI will be released in the morning. Aussie is not in the best shape right now. The Australian dollar has fallen to 0.6520, a sharp retreat from the week's highs. Earlier this week, the Reserve Bank of Australia capped interest rates at a 12-year high of 4.35%, with the regulator withdrawing an early warning that another rate hike could not be ruled out, indicating confidence that inflation will continue to fall. Australian employment rose sharply in February, while the unemployment rate fell well below forecast, a clear sign that the labor market remains tight. Inflation held at a two-year low of 3.4% in January, and the latest reading has analysts expecting price pressures to rise to 3.6%, especially as the Reserve Bank of Australia is targeting an inflation rate between 2 and 3%. The RBA will likely monitor Wednesday's inflation data, as February's data will reflect more price changes for a number of services, which have been declining at a slower pace than goods. If the data is in line with the forecast, the Aussie may get a chance to strengthen against the US dollar, but if price pressures continue to cool down, the Australian dollar will continue to lose ground. This was a brief overview of the most important economic events from InstaForex analysts. Follow us and make hefty profits from your trades. See you online soon!